Welcome to Bill's Gang YouTube, and hope you had a wonderful new year. And this is, of course, the beginning of the new year, and I want to talk about the market crash that's coming in 2016. Now, everything's a probability. We know that. Not saying it's for certain, but let me tell you why it's a very, very high probability. First, let's identify how the stock market got where it is from 2009 all the way up to where it is today. That's quite a hike. That's 200% move. Now, how did it get there? And why is it going to crash? Well, it's real simple. What makes a stock market go up is consumer discretionary spending. So if consumers spend money, it comes down to the bottom line of the company. They make earnings, profits. As long as their earnings and profits increase more than their overhead, the stock goes up. Real simple concept. But there was a problem. The market's going up without earnings, without profits. How could that be? It's called financial engineering. Okay, financial engineering. Here it is. And these are the two bozos, clowns, that did the financial engineering going back in 2008, 9, and of course now her. So here's what's going on. The market all of a sudden stopped. That's right. In the last 9 months, the market stopped dead. 33 times the market tried to break out and it couldn't break out. 33 times she tried to bust out. She just couldn't break out. Just couldn't break out. Tried, couldn't break out, couldn't break out, couldn't break out. Tried again, couldn't break out, couldn't break out. Why? Well, because there's not enough money coming in. Well, how much money came into the market? Well, that's the interesting. Not enough to move it up 200%. There was enough money coming into market to move it up 100%. So the stock market is 50% overvalued. So that means we know the stock market can drop at least 50%. Here's how. When we started in 2009, okay, the market 2009 right here. Okay, when it started in 2009, what they did is start with what they call QE. What's that? Well, first thing they do is they got to move all the investors out of the bond market right here. And how do they get the bond out of the bond market into the stock market? Easy. The yields or interest for 10 years is about 2.5%. Pretty nice. So countries like China and the Saudis and the French and the Germans, they love coming over and buying our treasuries, which is the same thing as buying our debt. So they love to have 10 years at 2.5% interest. They love that. So when there wasn't, after the stock market collapsed, when it dropped, people were out of work. 120 million people were out of work. So where were they going to get the discretionary spending? Now that's important because 70% of our economy's growth comes from consumers consuming, but they weren't consuming because they didn't have money. So they had to replace the money from the consumer. What they did is did financial engineering, and they turned around and decided to print their own money to put in the market. And here's how they did it. The first thing they decided to do is to print $85 billion. $85 billion right here. They printed $85 billion every month, starting in 2009, and they fed Bernanke, sent his boys over to buy the bonds. The bond rate dropped. The bond rate dropped all the way down to from 2.5 to 1.5. So that means that the countries that always bought bonds moved all their money over to here. So all the money moved here, and therefore the stock market in 2009 started to move up. Now, that's one way. The next thing they did is print more money. So they printed 85 billion. They got the printing machine going again, and they printed another $3 trillion of money. Actually, 3.3 trillion. Okay, 3.3 trillion. This over here was 85 billion. Okay, so the 3.3 trillion, what did they do with that? That was called QE1, QE2 in the twist, and QE3. And what they did is they took all that money and shoved it in the stock market. And the stock market went up. Then they decided they needed some more money to push it because, again, there was no discretionary spending. We had an unemployment rate that was really 22% when they said it was 10%, and now it's 12% when they're saying it's 5%. So when you have consumer discretionary spending is everything, because 70% of our economy's growth, our GDP, comes from consumer consuming. That includes automobiles, household durable goods, TVs, big screen TVs, that kind of thing, textiles, apparel, leisure, almost anything you can think of. Okay? And that's the GDP. All right? And that we'll put over here. This is the GDP. We'll put it in blue right here. So this is the GDP. So the GDP, okay, it was only growing at 1.1%. That's it, 1.1%. So there wasn't enough spending going on to get the economy growing. So instead of growing the economy, they figured they would grow the stock market. So let's put the economy over here. So we're at 1. Here's the economy. So the economy was growing really slow. So there's the economy. We'll put this E for the economy right here. So now they decided they needed more money. Well, what's happening was companies were not making any money. So their earnings were dropping. Their profits were dropping. So here you are, okay, you're a company. All right, you're a company and you make stuff, right? The problem is when you were making stuff and you're a company, and let's say you were making jeans, okay, you weren't selling enough jeans. So the problem, you weren't selling enough jeans. So your profits, your earnings started to go down. So at first, your profits were going up, and then we had that big crash, right? So the profits were going up nicely, and then we had that big stock market crash right over here, right? And the earnings came down to nothing. So now they had to get the stock market up without companies having profits because people had no money. So what they did, they printed the 85 billion. Bought the bonds, scared everybody out of the bond market into the stock market. Then they printed 3.37 trillion, threw that in the stock market. Now they decided to print another 5 trillion right here, another 5 trillion for stock buybacks. Now let me tell you when that started. That started right here in 2012. Right here. So 2012 is when they stopped with QE1, QE2, QE3. The 85 billion was all done. That's gone. They weren't doing that anymore. The 3.3 trillion, QE1, 2, and 3, they put an infusion of cash in, was gone. So now what happened was in 2012, what was helping the economy grow was China, because China was on to a big, massive construction. They were building condos and cities all over the nation, all over, but nobody was living in them. But that helped drive the market up in 2012, along with buying the 85 billion, putting 3.3 trillion in. In the meantime, our GDP wasn't growing. Our earnings weren't growing. Our GDP wasn't growing. Companies weren't growing. There's no growth. But what was growing was the stock market. China stopped. They stopped in 2012. All that construction stopped. Now, this didn't help the market because remember, the reason why the market was going up was because of the 85 billion, the 3.3 trillion, plus China, all the commodities were going up, and the banks were buying a lot of the commodities, and hedge funds were making a fortune on commodities to move the stock market up. But now the commodities were gone. What were they going to do? Okay. In the meantime, remember the other bubbles all broke about the same time. Right here is 2012. If I put up the bubble market, it looked like this. You had the tech bubble. You had this housing bubble. And then in 2012, when it was supposed to stop right here for the QE bubble right here, and it should have came back down right here. Just like any addict, they were having too much fun and they couldn't stop. So what they decided to do? They said, let's print more money. We'll print another 5.5 trillion and we'll give that to companies who, again, they don't have any customers to buy stuff. So their earnings, the earnings of companies like this company here, the earnings were going down. That means profits were going down. Earnings were going down and profits were going down, and their stock price should have been going down. But instead, what they decided to do is they would say to these companies, we'll print 5.5 trillion. We'll put it in here, the 5.5 trillion. This is when it started. You guys go, we'll give you all this money, interest free. Okay. And then what you do with that 5.5 trillion is buy your own shares. So as your earnings or profits were dropping, so make sure your stocks weren't going down, you buy your own shares. That means there's less shares in the company. So let's say you had 1,000 shares and you decided you're going to take that 1,000 shares and buy half of them. So now you only got 500 shares. With less shares, that means you're spreading earnings over fewer shares. That pushes your stock up. And that's how they cheat. It's an accounting trick. So all you do is earnings are dropping, your stock should drop. To make sure your stock doesn't drop, you borrow money, and they did, 5.5 trillion, and that's why you savers, they cut your interest rate in savings from 5% down to less than 1% because you had to make up the difference. So now what happened is, instead of a company having 1,000 shares, they only have 500 shares. So when you spread your earnings, you weren't spreading over 1,000 shares, you're spreading over 500 shares, so your earnings look better. Your earnings go up artificially. See, so the earnings go up instead of down artificially, and then your stock price goes up. So that's how they masked the bad earnings and the bad profits. So the stock market was on its way again. Now the hedge funds got really excited. They're addicted already through this big move. They wanted more of it. So they decided, they went to the Fed and had the Fed print another 2 point. Here we go, right here. They printed another 2 trillion, 2 with a T, trillion dollars. And the $2 trillion was given to all the hedge funds to buy stock. So now, as earnings kept getting worse, the next quarter, remember what happened? The first quarter, earnings went down a negative 4.7. The second quarter, it went down a negative 0.7, and then it went down in the third quarter, went down another 4 points. All right, third quarter, 4.4 third, and then the fourth quarter, these are all negative now. This is negative 2, and then the last quarter went down again. The fourth quarter is 4.7. So while earnings were going down, profits going down, all these profits were going down, stock prices were going, the stock price of a company would go up. Isn't that interesting? So again, while the earnings were coming down, stock prices should be coming down, but instead, stock prices went up 7 times higher faster than earnings. That's called financial engineering. So stock prices kept going up. So see, the stock prices should have stopped right here. This bubble should have stopped right here in 2012 and came down like the other ones. But instead, instead they got greedy. So instead, they said, no, let's do this here. Let's continue. And Bernanke agreed, let's fake everybody out and let a small segment of the population, the 1 percentile, get even richer, and we'll continue the bubble. And that's where we are right here. They continued the bubble. And here it is. So the bubble kept going up. So now we reached a point where we got up all the way up here, and now the amount of money that they were borrowing to the hedge funds to buy stocks, okay, there were so few people borrowing so much money that it stopped. And it looked like this right here. I'll show you what it looked like on the chart. This is what it looked like on the chart right here. Let me show you. Look, Look just like this right here. I'll show you if I can get it up. Move it over a little bit so out of the way. This is the stock market right here. Blue line's the stock market, see? So this is the money they're borrowing. So they borrowed 600%. The amount of money they borrowed to push the stock market up 200%, they borrowed 600%. They can't borrow anymore. So that's why the stock market stopped. Because again, the economy is getting worse, earnings were getting worse, profits were getting worse, but they kept pushing the stocks up artificially. So here, think of it this way here. What they did by doing this, think of it this way here. Here's a big hook. There's the stock market where it is today. There's a big hook. And what they did is they took and they put a big hook down here and hooked it right to the market to hold it up. And that's all of this is 600%. Now remember, in 2008, they increased the margin debt, borrowing money by 500%, and the earnings were better than today, but the market crashed. Back here in 2000, they increased their earnings increased their buying of money to buy stocks was up 300%. The earnings were better than today, but it crashed. 2009, they increased their borrowing to buy shares by 500%. Earnings were even better than today, so they borrowed less and earnings were better in both of these crashes. This one hasn't crashed yet. Why? Because they've been because there was so much money coming in the market, holding the market up from the hedge funds. Now the hedge funds aren't stopped. And that's why the market one of the reasons why the market has turned around and going to collapse. It's not sustainable anymore. This was all artificial. This whole stock market right here going up was all from this market pushing all this money, pushing this up 200%. That's what happened, and that's why today the market is going into a crash and should crash in 2006, and why you should be a gang member so you can learn how to short stock. Stop listening to these people saying shorting is dangerous. Remember, it's crazy. If you're going to make a 10% return on your money, it's a lot easier if you are not only buying stocks when they go up, but you are selling stocks short when they go down. Doesn't that make sense? So you make a lot more money if you're on both sides of the transaction. But they've got you just buying stocks. With a gang, we got you buying and we got you shorting. Very simple. Join my gang, philsgang.com. See you on the charts.